What's going on, guys? It's Kyle. Welcome to the Stock Goat YouTube channel. In today's video, we're going to be covering the Sofi stock. I have a lot of great information for you guys, and I think 2024 is going to be an absolutely stellar year across the board. So be sure to smash the like button. Let's try and get this video to 1,000 likes. Don't forget to drop a comment. What are your price predictions for Sofi next year? Are you buying right now? Selling? I want to hear everything, guys. I'm going to be coming back to all of you. But guys, I'm telling you right now, looking at the information that I'm about to bring to you today is going to be mind blowing. If you listen to SoFi's management, what they have continued to point out is they are going to be profitable in Q4 and full year profitability every single quarter next year. They're going to be dropping all of their top line revenue growth straight to the bottom line. Why is that? That's because they have scaled all of their products and businesses. Galileo expenses are going to drastically slow down because they've been investing so aggressively the past 1 to 2 years. Same thing with financial services. They've been losing money for the past, 2, 3 years, and now they have scaled that to profitability. So all of this revenue is going to be dropping down to the bottom line. So you are finally going to see SoFi flex its muscles as a bank, but as a bank offering zero branches, fully digital, and you are really going to see the type of growth that, a business like this, fully integrated, digital platform can really do. And I'm going to show you guys, what type of profits we could be seeing. And also, I'm going to be pricing this company, straight next to these legacy banks. And I know you guys, some bears out there, they put in eyes of the bulls the fear of, being priced as a bank forever, guys. I'm telling you right now, that is not going to happen. Even if you use the legacy metric of a PE ratio, if SoFi just gets to the profits that I'm looking at by the end of the year, you have to understand growth and earnings growth alongside, net income profit. And SoFi is going to be showing 25 to 35% growth for the next 5 to 10 years. These legacy banks, are literally showing the same revenue as they were in 2009, 15 years ago. Some of them are showing the same revenue for 15 whole years. You're not going to get, that legacy PE ratio, of a 10, of what a lot of people are fearing. We're going to show you what, some of the higher end banks showing a lot of digital transformation are getting as a P ratio. I'm going to, compare those to you, and we're going to try and come down to a conclusion of what we should price SoFi at if we get to these metrics that I'm going to show you guys. So be sure to smash the like button. Don't forget to drop a comment. Let's get into it. All right, guys. So I know a lot of you guys are always thinking about that, bearish PE ratio of a 10 for these legacy banks. Yes, guys. Those are some of the, most legacy banks that have been around 100, 200 years, offer a massive dividend and, continue to grow the business by, 5 to 10%. Goldman Sachs, a more technology innovative bank, you can see they're priced at a 18.42 PE ratio. So even some of these legacy banks are not getting 10 PE ratios right now that the market has showed a little bit of a bounce. We also have another legacy bank, Morgan Stanley, priced at a 16.4 PE ratio, not exactly a 10. So as you guys can see, that was what we were looking at in 2022. Some of these companies were sitting at a 10 PE ratio, some of these banks. But guys, that those banks grow at no rate at all, 5-10%. That's why you're getting a 10 PE ratio, especially when you got a bloated massive dividend as well. I just think SoFi is going to have the fastest growth in the next decade because they have everything fully integrated, fully digital, and that's where you're going to get the cost savings. When you don't have those massive branches, you can continue to scale growth and reward your customers. Now, guys, I want to look at Goldman Sachs real quick just to see why are they priced at the highest growth possible at at 18 right now PE. Let's go back 4 quarters and just look at their revenue growth, net income. You can see negative 21%, negative 66 on the net income, $1.3 billion profit, not bad. You can see they scaled up right here at, a break-even growth on the revenue, negative 18% on the net income at $3 billion profit. Next quarter over, guys, you can see they went down 8% again, back to $1 billion net income, negative 15% earnings. So you can see there's no consistency on some of these banks. It's a hit or miss every quarter because they don't have that digital infrastructure to really see where the markets are going. They're just busy, racking up those fees and turning a profit, as much as they can every single quarter. And as we can see, the last quarter, it looks like they're trying to get back on track at 3% growth, $2 billion profit, negative 32% earnings growth. So guys, as you can see, I mean, this is the most highest price, legacy bank right now inside the top 10. and they're growing at 3% and then negative revenue growth the last 4 quarters. So there's really nothing to see here, guys. This is what an 18 PE ratio is going to get you guys. I'm not seeing it right now. I'm just seeing inconsistency. Morgan Stanley, guys, you can see negative 12% revenue growth 4 quarters ago, negative 40% earnings, net income, $2 billion profit. Next quarter over, negative 3% revenue growth, $3 million profit, negative 18% earnings. 2 quarters ago, 2% growth, $2 billion profit, negative 12% net income. And then the most recent quarter, guys, 1% growth, negative 8% net income profit. So, guys, as you can see, a lot of inconsistency. Both of these companies, 1 to 2% range on the last quarter. So just 1 year of absolutely nothing, guys. The stocks have bounced back, but guys, these are the highest priced banks. 16 and 18 PE ratios. And we're not going to look at, the earnings on the other banks, but as you guys can see, we also have Bank of America, Wells Fargo, and JP Morgan are those bearish 10s and 9s PE ratios, of course. And, that's pretty much what you're going to get for a legacy bank, a fat dividend, continued profits, and, 5 to 10% growth max. But as you can see, Goldman Sachs and Morgan Stanley aren't even showing that the most recent quarter. So, guys, I mean, the absolute bearish case scenario I could see for SoFi after they start turning up profit and you put them on a 4 PE ratio of their most recent quarter, I could see like a 20 PE, guys, okay? That would be the bearish case scenario with a company like SoFi growing 30 to 35% revenue growth. EPS is going to be growing right in line to the bottom line next year. Now let's look at what type of earnings we could potentially see next year if SoFi management fulfills what they said they're going to do on dropping everything to the bottom line and continuing to maintain, 5 to 600,000 membership growth. But the reason why we're going to see that bottom line now is because SoFi is seeing that customer acquisition costs continuously drop, and they are starting to really target their members because they've grown their member base so drastically, so they can continue to cross buy multiple products to their members, and that's why we're going to see a drastic bottom line increase in EBITDA this upcoming quarter of $50 million plus, going about 100 to 150 million in EBITDA. So guys, as you can see here, I literally broke down every single metric the next 5 quarters. This most recent quarter coming up, the Q4, is going to be in the last video when I show what type of profit they can see, guys. And if they just drop that top line revenue to the bottom line, we should get SoFi started out at a $35 million profit. Revenue growth 32%. That's a 6% margin on the net income. Finally, that's awesome, guys. First profitable quarter ever. EBITDA would be at 154 million. That's a 27% margin. That's jumping up 10%. And if we continue to see the company just grow at a $40 million quarter over quarter rate, remember, guys, the most recent quarter for Q4, they're expecting a $55 million jump. So I just dropped it down to about 40 million every single quarter. $40 million increase, $40 million increase, $40 million increase, and a $40 million increase. And all of that profit, revenue growth is going to go straight to the bottom line on EBITDA and net income. So we're going to get a 75 million net income, 115 million net income, 155 million net income. And then by the end of the year, oops, I got to change this to Q4. Q4 net income should come in at about $195 million, guys, at a 26% margin. Full year, we should come in at about 2.75 billion revenue, 33% growth. Remember, guys, this year they're supposed to put up about 34%. So back-to-back, same 30 to 35% revenue growth. Absolutely insane. Net income should come in at 540 million for the full year. EBITDA right around $1 billion at a 36% margin. So guys, SoFi should really flex their muscles hard to just show what they really can do as a bank, fully digital, optimized for cost savings, putting all their profits back to the customer on that 4.7% APY. This is what we've been waiting for, guys. This is the digital shift. We've seen it with Netflix and Blockbuster. We've seen it with, Amazon, with all the other, Toys R Us, stuff like that. You are going to see a digital shift happen in banking because it's just never happened. SoFi has really put their foot on the gas the past 3 years since going public. Scaled to 7 million members. They should scale up to 10 million members in 2024. And now we should start turning a profit. Of course, we're not going to be turning a $1 billion profit out of nowhere, but you're going to continue to see that maintain, 30% growth, expanded EBITDA margins, guys. I mean, it's looking good, guys. 200 million, and we'll just scale that at a forward PE of 800 million. So at $800 million net income, we need to figure out what type of PE ratio we should get on SoFi. The fastest growing, bank in America, fully digital, cost savings. Same thing, along with the other companies that had the digital shift, Blockbuster to Netflix, Toys R Us, the Amazon, stuff like that. You also got the car business, Ford, GM, and then you got Tesla. Tesla accelerated to 1,000 PE ratio at one point in 2020. I'm not saying we're gonna get 1,000 PE ratio, guys. I'm trying to be really realistic with you guys of what type of valuation we can get at. So, I would personally think we could double Morgan Stanley and Goldman Sachs at about a 36 PE ratio, guys. I mean, none of these companies that you're seeing that are getting these PEs right now are even growing 5% the last 4 quarters. We just checked the last 4 quarters. Morgan Stanley and Goldman Sachs hadn't had 1 quarter of 5% growth. Okay. 36 PE ratio, $800 million run rate net income on the Q4. That'll get us a 4 PE. We just got to see, what this comes out to. And this comes out to $28.8 billion, guys. We know the outstanding shares are 950 million. So we are looking at a $30 stock, guys, going off of SoFi's potential profits. If they can grow 33% and drop everything to the bottom line going forward, guys, I think we're going to be at an $800 million run rate net income. 36 PE ratio, guys. You can see what the legacy banks are priced at right now. Wells Fargo, JP Morgan, and another one, 10 PEs, and then the top of the line banks right now, growing right at about 18 PE. So, guys, I think 36 is very realistic on the fastest growing bank in America. And we just need to turn a profit and then start growing our profits continuously so we can get more institutional investors, guys. But yes, I got a $30 price target on this stock for next year. It's just a matter of time before this bad boy explodes. There's no telling if we get a crazy bubble run and the PE explodes like 100, 200 or something like that, and the stock freaking runs to 50, 60. Who knows? I'm just saying base case scenario, pricing in the type of growth that SoFi could see. This is what type of stock we could be looking at. If you made it to the end of the video, I want to say I really do appreciate it. I enjoy doing this video for you guys. It's just a matter of time before SoFi absolutely takes off. This is a company that is growing absolutely consistent as possible. Great management in place, and a management that is really pushing for profitability in the next 5 weeks on our Q4 earnings call. I really want to see, what the guidance is going to be for 2024, but it should be absolutely stellar because we could potentially see some rate cuts. So if I can start offsetting those personal loans and see other businesses scale as well, such as, mortgages, student loans coming back, Galileo, we got, big bank clients signing to us. The list goes on. It's a well-diversified business. It's giving back to the customer. It's going to continue to get more users to the platform. Let's see us at 10 million users next year. $800 million run rate, PE ratio 36. It's a fair value on a 35% growing bank at a profitability, $30 price target. Once again, my name is Kyle. Hope you have a great day.